This should be fun. Thank you for the wave back. I got one. In the next 28 minutes, we're going to go really fast. I want to talk about why does this always seem so hard? How many founders do we have in the room? Hands up. Do we have any investors in the room? We have a couple. For the founders, I'm going to try not to scare the crap out of you. For the investors, I am not here to malign you. The idea of this talk is that there is a gap between these two worlds that is often misunderstood. My first startup was 18 years ago. I didn't understand why it was so hard. I didn't understand why it took 18 months and 120 pitches before I had my first term sheet. I didn't understand why it was so hard. I didn't understand why my investors funded my first bridge round when I needed a little help between round A and round B, but they wouldn't do the second one. I didn't understand. I didn't understand when we finally got to an exit, and I was thrilled. They weren't. I didn't understand. And then I went on to a second startup. The second one did really well, and all the investors were really happy all the way through, but there were still these structural gaps that kept kind of punching me in the face. Well, it's now 10 years later, and I know now. I learned. My firm has now supported 200 startups over the last decade. We've done 350 fundraisers. I've been in more board meetings than I can count. And none of that is to brag. It's just to say, like, it took me a frickin' long time to find out. Why is there this gap between these two audiences that so importantly need each other? And the point of this talk is to try and lay bare, to put a light on the structural differences between these two audiences. Because when it works, this is the most powerful catalytic relationship that exists in our economy. When you match CEO with great investor and they put capital to work towards a business that makes sense in the marketplace, just beautiful things happen. But let's talk about the two audiences first and talk about why they're so different. Let's talk about the founder first. Founders build with no map. They're nuts. They're often masochists, at least I was. The only way you can do it more than once is with that in mind. They make irrational bets on intuition, and through sheer force of will, they will birth something into existence. They're not just selling a product, they're selling the future. And they're talking about the future in the present tense. That takes delusion. That's not an insult. You couldn't do this without it. But behind that delusion, just underneath it, is a whole lot of fear. For the founders in the room, the ones who raised their hands a short while ago, do me a favor and join me in this. Raise your hand if you've ever worried about running out of money. Cool. Some hands go up. You were ever worried about, I don't know, being found out that you're an imposter, you don't actually know what you're doing? Oh, cool. A few more hands. Maybe you're worried that your better funded competitor is about to kick your ass. Yeah, number of hands. You'll let down the people you care about? And all those people that thought you were crazy for even starting the company in the first place will be right. Yeah, the half hands are my favorites. It's like, yes, it's true, but I don't want all of you to know it. Founders have to sell dreams. The founder journey's hard. And what makes it so damn hard is that you're selling fantasy. You're selling an unrealized future. And the bigger the dream, often, the more money is needed. And that usually means someone else's money. Because doing something from scratch yourself is risky. And I'm sure there are some bootstrap founders in the audience. Phenomenal work. Like, that's unbelievably hard. It's all hard. It's just different types of hard. But you could just take out a mortgage and a bigger credit card or have a side hustle that pays for while you get your startup going. It's just a different form of risk. But for the startups that have really big ambition, like they're trying to go build a company that can put a dent into the world, see if you can use someone else's money. But here's the thing. Most founders who do that for the first time, they have this imagination that they'll convince an investor to give them that money, and that investor will never talk to them again unless they ask. They'll just be left completely alone with millions of dollars and freedom to operate. If I outline what founders want from investors, and I've had this conversation obsessively with founders, they all say the same thing. One, they want money, they want capital. Two, as little dilution as humanly possible. Three, tiny, minimal supervision. Basically, you don't call me, I'll call you. And for big decisions, rubber stamps. Sure, they want you to take the call, but if they've already made up their mind, they're going to present like, I think the company should go left, not right. They're not presenting it as, here's an open discussion person who gave me millions of dollars. They want utterly aligned incentives. The founder and the investor, the founder wants the two of you to want the same things. And founders want advice, kind of. And they want introductions. It's not an unreasonable list to a founder. Investors do something very different. While founders sell dreams, investors use money that they raise from other people to fund those dreams. In other words, founders sell dreams, investors sell returns. It's a completely different job. Now let's talk about the math that sits under those returns. One more time, founders, hands up. Keep your hand up if you completely understand the economics of venture capital today. There it is. For the VCs in the room, hands up please. I know there's not many of you. Leave your hand up if you understand founder economics. Yeah. If you didn't notice the difference, the VCs know your math and you don't know theirs. It would really help empathy if you knew each other's. So founders, stay with me for a minute. Power law. How many of the founders in this room have heard this phrase? Got some hands. How many of the founders in this room really know what this phrase means as it relates to venture economics? 0 hands. VCs don't need every company to win. They don't even expect every company to win. Historically speaking, if we look at like the last 40 to 50 years of data, most VCs just need a couple of their investments to win. Pareto principle, the 80-20 rule. 20% of causes lead to 80% of outcomes. Have folks heard of the 80-20 rule in their lives at some point? Get some casual nods. I know it's late in the afternoon. If folks need to like mainline some caffeine, feel free to get up and come back to me. In venture, it's actually more extreme. It's the 90-20 rule. 20% of investments lead to 90% of outcomes. I'll actually throw some stats at you that might blow your mind. 65% of investments made in venture into startups like yours don't even return the original capital put into the business. More extreme one, there was one private equity firm that looked like 7,000 deals over a long cohort of companies. They found that 5% of all the investments led to 60% of all the returns. This feels like a bad deal. Why would you even be a VC? Well, because Benchmark put not even $7 million into Uber and they got $7 billion back. That's power law. A small number of these investments are expected to return the fund. Limited partners, pension funds, large private equity firms, fund of funds, family offices, they want a diversified portfolio. So they take a chunk of their money and they give it to venture capital firms for a high-risk portion of their investment strategy. Those VCs then take that money and they meet thousands of you each year and they place a number of bets. So the cycle goes LP to VC to the startup. And then if the exits happen, all 3 audiences win. So VCs need the limited partners, and limited partners want a return. I am now going to give you a grossly oversimplified view into the math of venture. And the reason I'll do that is not because the founders in the room, I'm not asking you to become future venture capitalists. What I'm asking for you to do is have empathy for the audience you need to collaborate with. So, if that venture firm returns 1x on their money, or less, there's not going to be another fund. When they call those same LPs and say, hey, I'd like to do this again, the answer is going to be no. If they generate between 1.5 to 2, and they call that same LP, I'm going to do a new fund, the answer is going to be definitely maybe. We should talk again. What's your schedule 3 months from now? By the way, for the founders in the room, how similar does that sound to you for how you get responded to from the VCs who say you're too early? I got one very similar. I'm just going to go with that one. Meanwhile, for the venture firm that returns 3x, guess what happens? They get to play again. So, really simple math. $100 million fund. They need to get to 3x to be able to play the game again. So 100 million needs to return 300 million. For the VCs in the room, I know this is an overly simplified view. Please bear with me. Generally speaking, let's say they own 10% of each of their companies. How much in return do they have to generate to get to $300 million? So they have to get to $3 billion. We've already discussed 65% of startups don't even get their invested capital back. Many of them are zeros. So 2/3 of the companies are going to fail. That means a couple of them have to be gigantic in order to get to $3 billion of outcomes, so that this venture firm can have a second go at it with the LPs. An unnamed Sequoia partner, and man, have I hunted for this quote, I haven't been able to find the person to give credit to, used this metaphor a long time ago. And this is a really important idea that I think founders should pay attention to. What do VCs look for in a startup? This Sequoia partner said, a startup is like a surfer on a surfboard on a wave. The surfer is the founder. The surfboard is the product. The wave is the market. What are they looking for? A killer surfer on an amazing frickin' board, and they are surfing outside of Portugal. They're looking for all three. Why does that matter? Because if I have a great founder and a great product and the market sucks, it doesn't matter. If there's no wave, it doesn't matter. Why did I have so much trouble raising capital for my first startup? I'd like to believe I was a pretty good surfer, even though my balance sucks. My surfboard was probably good because the product really worked. In retrospect, 18 years later, my market sucked. My market was terrible. It was competitive at low margins. That sounds great. I didn't know any better. The point being, for the founders in the room, if you're getting rejected on market size, if you're getting rejected on how crowded the space is, or how fast-moving the space is, there's no amount of selling or story you can do that's going to counteract the fact that you're surfing in a place with no wave. So I already gave you a list of what founders want from investors. Well, what investors want from founders? They want to be able to write checks, so they want the opportunity for an allocation. They want that allocation to get them an interesting amount of the business. Putting in a whole lot of time and effort to own 1% or 2% or 3% of the business can't get them to the $3 billion of outcomes we described earlier. They want real professional governance. If they're going to hand you millions of dollars to go operate your business, they want to know controls are in place. They want to know board meetings are professionally done. They want to know books are closed each month and each quarter. They want to see a financial plan for next year, and that is not them being corporate or bureaucratic or heavy-handed. It's them being professional, and they want the same from you. They're going to want veto power over big decisions. What's a big decision? It's negotiable. Take on more equity, take on debt, sell the business, major layoff. These are big decisions. They're going to want some protections on their money. We're going to talk a little bit more about that. But they want some downside protection. Why? Because they know 2/3 of their investments aren't going to work. And in those scenarios, they're trying to do right by their LPs. Can I get some of that money back even if things go south? And this list is not ranked order. These all matter to them. Investors also want, from founders, the opportunity to add value. They're not interested in being utterly passive. There are a few firms with that as a thesis, but most do not, especially early stage. They have network, they have expertise, they know what they're doing. They want the chance to help. Let's talk a little bit more about protections. You're both jumping out of a plane. One of you has an umbrella. One of you has a parachute. Only one of those is going to work. Liquidation preferences, protective provisions, preferred shares. These are all ways of allowing your investor to protect their investment in case things don't go the way they're supposed to. Is that bad? Is that evil? Nope. Is it what the market allows? Yep. For the founders in the room with unbelievable amounts of leverage, your company is growing like Cursor or Replit. You can negotiate whatever you want. You might be able to get rid of all of these. For the vast majority of you, with good traction on interesting businesses in a market such as a surf that actually is attractive, a bunch of these are going to stay. I don't point these out to say that they're good or bad. I point these out to say they exist. And it's part of the structural gap between these two audiences. You have the same dream. You both want to build a giant business. But you are taking very different risk. The founder's laying on the table while a robot does surgery, and the investor's watching. It is a little gruesome, but the image was happy. Like, it made me happy, sorry. So let's line these up. The founder wants capital, nominal dilution, minimal supervision, rubber stamp decisions, but they really do want aligned incentives, and they want advice introductions, but usually on their terms. What do investors want? They want the chance to write checks, but they want material ownership. They want professional governance. They want a voice, if not a veto, on big decisions. They want to protect their downside, and they want to add value. Some of these line up beautifully. Founders want capital. Investors make money by making investments and selling returns to LPs. Those line up beautifully. Founders want aligned incentives. Investors want protection. There are structural gaps between these two audiences. I am not suggesting that there is some silver bullet that flies through the space of this ecosystem and solves it. What I am suggesting is founders get smart on this, so that as you work with investors, you understand their machine. You understand the ecosystem they operate with. Here's where it gets really tricky. There is a giant difference between how both sides of this game, both the founders in this room and the investors in this room, present themselves, their dating profiles, versus what they look like when they show up. Founders, raise your hand if you've ever embellished in front of an investor. Oh, stop lying to me. That's half of this conference. You've never called a free pilot a customer? Really? No one? You've never called a freelancer a full-time member of the team? You've never called your janky demo my first full-fledged product that we launched as generally available? Okay, I guess it was simply just me who did these things. And investors are guilty of the same theater. They're also not immune to embellishments. I've met investors who will say, I'm actively investing, but they haven't even raised the fund yet. They'll only talk about the successful startups they've had in their portfolio and not the scandalous dumpster fires that ended up in there as well. They'll reference their board roles, but won't mention the fact that some of them they have seats where they can vote and some of them seats where they can't, or where they're barely even involved because the meetings don't occur. Or they'll reference their enormous network of incredibly capable entrepreneurs and founders that they can give you access to, and they don't reference the fact that, but you better do well enough for me to spend that currency. Both sides embellish, both sides play a game. And as a result, we've created this ecosystem where founders try and hide their bad news all the time. And our investor colleagues have to become investigative journalists, detectives with a magnifying glass to do forensics to see which parts were real and which parts were bullshit. Everyone's bluffing, everyone's anxious. Okay, now that I've depressed all of you sufficiently, don't worry, drinks are in like an hour or something. I'm not here to raise your anxiety. For the founders in the room that are here to raise capital, either now or in the near future, I point this out to shine a light on how the world works. Not to talk you out of it or not to complain. The conflict that exists in this world is structural, but not in fact insurmountable. And the reason it's not insurmountable is because neither party is a bad actor. It's simply that founders are selling unrealized dreams, investors are buying stock in an unfinished story. And so long as we have different classes of stock, so long as we have power law math that says go big or go home, so long as investors have competing fiduciary, where they have a legal obligation both to the startup and to their partners in the firm and to the LPs that have taken money from, that these gaps and these points of friction are going to exist. And I can tell you, 10 years of advising CEOs, we have a great number of stories across the ecosystem of this marriage working out beautifully, where investors and founders can come together, have open discussions, and build companies together that are worth extraordinary amounts of money. And those relationships, when they work really well, there's a pattern. There's an independent board, conflicts of interest are discussed openly, there's regular proactive communications, grievances are aired. And that leaves me with advice. My biggest pet peeve in life is receiving unsolicited advice. I hate it. So extreme, by the way, that if I'm in the car and I turn on the GPS and I reach the point in the drive home that I already know where I'm going, I'm like, shut up, Google! Because I can't have someone telling me what to do. I blame my dad. But since you're sitting here, I'm going to suggest that this isn't unsolicited. You want to hear this, I'll keep going. I have advice for founders as it relates to engaging your investors. First, please don't embellish today. Whatever the status of your business is today, be honest about the status of your business today. You have pilots, you have pilots. You have a product that's kind of working, great, it's kind of working. You've had some churn, admit the churn. But talk big, big game about tomorrow. Here's where I am, that's where I want to go. Second, be proactive and upfront with bad news. An investor said to me a long time ago, and it stayed with me forever, anytime there's a gap in comms from one of the CEOs I've invested in, I know it's bad news. Don't let there be a gap. Things are going well, communicate it. Things are going badly, communicate it. 3, there are expectations and there are agreements. Expectation. I really thought my wife was picking up my daughter after preschool today and that I was going to cook dinner. Now, 3 parties lost in that expectation. My daughter didn't get picked up. My wife was bringing home dinner, and I was cooking. Expectations suck. Expectations are simply uncommunicated asks. Agreements are wonderful. I will do this if you do this, and we'll do this by this time. When founders are working with their VCs, get away from expectations. I really thought you'd make those introductions by now. I thought you'd have feedback on that deck that I had sent you. I thought you were going to interview that candidate for me by Thursday. I thought, weren't you going to? Those are all expectations. No, explicit agreements. Can you interview this person for me by Thursday? They can say no or yes and renegotiate, but be explicit. Last, the easiest way to kill a relationship between a founder and an investor is when the founder just keeps trying to sell the investor. Try and convince the investor, debate with the investor, as opposed to, here are the facts on the ground. Here's what I think happens next. Ask me questions. So, one of our companies has 13 months of money left. They are $5 million in revenue and growing moderately well in a space that's a little too crowded with more than $60 million invested life to date. It's a tough situation, whether or not they should raise any more money or they should try and sell the business. What should they do? The founder, the CEO, has a very strong point of view. We should do this. We should try and sell the company and sell the company now. And he was presenting to a board. And he wanted to only present that option. And I said, that is the easiest way to lose credibility. The company has options. What are they? Even the shitty ones. Walk through them all. One of the options is, this is the kind of company that could go down to skeleton crew, and it could cost almost nothing to run, and it could throw off some cash and be profitable. And maybe an exit happens one day in the future, but it also could just start to send dividends back to investors and try and get people money over time. Is that a good idea? No. Is it one of them? Yep. Founders, be honest with your audience. Tell them everything, and then tell them why, which one you choose. Let's switch to investors. Please remember that for the founder, this is everything, and for you, it's a part of a portfolio. If you can tap into that empathy every time you talk to the founder, the conversation will be better, because the founder wants to be felt. Be direct about conflicts. One of our companies, their VC, invested in a direct competitor. Absolute direct competitor. Now, the right way to do that, in my opinion, would have been the VC saying to the entrepreneur, we invest in the space. We're going to make multiple bets in the space. This is how we partition information across the partners. What we know about your company will never be jeopardized. They didn't do any of that. They hid it. They tried to pretend it never happened, and instead, my founder learned from a third party. Just be direct. Doesn't mean it'll be easy, but avoiding the theater. We won't invest in your next bridge round. Here's why. Not the thing the founder wants to hear, but at least it's direct. Lean in where you're an expert, otherwise make introductions. What often gets this relationship sideways is the investor who thinks they have to have the answer, so they try and create one. It's like when an LLM hallucinates. I don't say that to insult investors. I say it, they're trying to be helpful such to the point where they're going to say something even when they don't have expertise, as opposed to leveraging their network to go grab the answer. And last, when problems arise, please God, investors, talk to the founder, not about the founder. That's one of the biggest problems I see in venture, and particularly in boardrooms. Hey, we're going to have a closed session now. Can the CEO walk out of the room? I'm not saying that's a bad idea. I'm saying whatever gets discussed in that room, then it should be directly shared with the CEO themselves. But the moment this dynamic happens, that when the problems arise, people are talking about each other till to each other, bad things happen. I'm going to finish with this. Thank you, everybody, first of all. Thank you, thank you. My partners and I are on stage for 2 hours tomorrow, all about founder selling, founder-driven sales, storytelling, how to move beyond founder-driven sales, which will be very fun. For the founders in the room who are actively raising money right now or dealing with a board dynamic you want to chat about now, the QR code on your left is the one for you. For the really early stage ones who just want an introduction into what it means to be a CEO for the first time, the QR code on the right. I'm Jonathan Lowenar. Thanks, everybody. Enjoy Startup Fest.
Thank you, sir.
Thank you, buddy.